Hi everybody. Well, markets sparked into life last week, so this week we are previewing the aftermath of that volatility. We're also going to talk a little bit more about the Yuan fix and the influence the China currency is having over markets at the moment. And just quickly, it's worth noting there's some big cannabis stocks also reporting earnings this week. Now, the backdrop to all this is that we've had one of the worst weeks of 2019 for equity. It's been a great week for bond markets where yields have been plummeting, and it's that dive in yields which has actually been contributing towards the weakness in equities. In essence, people jumping in towards government bonds as safe havens and obviously exiting risky assets like equities, and very much jumping into other alternative havens outside the bond market, like specifically gold, which hits $1,500 an ounce this week and is probably set for further bullish expectations moving forward. Oil prices have now fallen $20 a barrel since the peak in April, and we saw more downside last week. And because of this, all this flight into safety, the yen has done very well in the FX market, while the Aussie and the Kiwi crashed when the RBNZ surprised with a half point cut in interest rates. Now, before we talk about all the details for this week, we're going to talk about the economic calendar first. So conveniently enough, given that a lot of all this volatility has been sparked by the escalation in the China trade war, we do have a lot of China data this week. So FDI first, so investment, foreign direct investment into China obviously will be telling as to general confidence about how China can weather this storm with further increased tariffs set to begin in September. We also have the retail sales and industrial production data, both of them important and both expected to drop, one for domestic demand, one for how well China goods are doing abroad. Actually, some of the other data suggesting still exports are up from China, but nonetheless, this data set is volatile, but you could see in such sensitive markets that if we did see perhaps these numbers decline much more than expected, then that could be very much a negative for equities. Equally, any topside surprise maybe could allay some of the concerns we saw last week. Unemployment from a few regions. I'll be watching UK wages. Obviously, UK data is somewhat secondary to Brexit at the moment. Possible no confidence vote in Boris Johnson come September. But still, in general, we need to see wages match the what is likely to be coming, some currency-induced inflation for the economy to keep ticking along. So otherwise, money coming out of people's pockets because the weakness in the pound drives up prices, inflation goes up, yet people's wages may remain stagnant or grow at the same pace. Hence, they're spending more but not getting as much. Now, conveniently enough, given that a lot of this volatility in markets has been as a result of the escalation in the trade war between the US and China, we have a lot of China data this week. FDI first, so obviously foreign investment into China, a sign of confidence across the globe in China's economy and its ability to weather this trade war storm. Retail sales and industrial production both important in terms of internal and external demand for Chinese goods. But the figures are pretty volatile. Maybe not too much importance will be attached to them. But given that markets are so sensitive right now to what's going on in China, you can imagine that disappointment could send markets fluttering again. Obviously, data coming in better than expected may allay some of the concerns around China and its influence on the global economy. Unemployment from a few regions. We were watching UK wages. The essence here is that the pound has been dropping a lot recently on these no-deal Brexit fears. So there's going to be some currency-induced inflation. So for the economy to keep doing well, wages need to keep up with that inflation. So hence watching the wage data. US CPI is going to be a key one with bond yields obviously dropping in the US in expectation of a September Fed rate cut. That is pretty much 100% baked into markets at the moment. Same goes with the Eurozone growth figures. Equally, the ECB, a deposit rate cut, also 100% priced in according to the rates market. So again, watching those figures to see whether there's any movement in market expectations for those central bank moves. So the question we're kind of asking this week, which is a natural one really after a big sell-off, is this volatility set to continue? I think there's two time periods to consider here. Over the short term, actually, when the volatility really kicked in, we'd already been on the end of quite a long slide in terms of a numerous day decline in the major stock indices globally. So short term, we're actually pretty oversold. So there is some scope for a bounce. But if you look longer term in terms of the time period of how these markets are performing, year-to-date returns are still looking pretty good even after the sell-off. Take the S&P 500, still up around 14% at the time of filming. So still a lot more room to drop and still have a tidy annual performance for these equity indices. So if you're a big-time investor feeling a little bit jittery about markets right now, it'd be understandable if you wanted to take some money off the table with already some nice gains locked in for the year. Fundamentals wise, not sure there will be too much more trade war escalation, but expectations are getting a lot more dovish for central banks. And while normally that's a good thing to see the prospect of lower interest rates, bond yields have been dropping just a bit too fast, and that's been unnerving stock markets. So if those dovish expectations continue, stock markets can continue to be feeling unnerved at the speed of the declines. Otherwise, an alternative scenario is that we see central bankers start to push back in terms of comments to suggest that maybe this big period of rate cuts is no longer in order. But then markets can sell off because central banks are not protecting them from the economic weakness. And that's, to some degree, what we're seeing at the moment is the aftermath of that Fed meeting when Jay Powell suggested that they were, in essence, one and done for the time being. Now, I want to talk about this Yuan fixing, not something that you'd typically watch day to day in terms of trading, but at the moment, the Chinese currency is quite important. And because it's not a free-floating currency, USD CNY, that's the onshore rate, is fixed every day by the Chinese central bank. Last week, for the first time since the financial crisis, USD CNY was fixed above 7. That was taken as a big symbol that they're going to let the Chinese currency weaken. Obviously, USD go up, CNY go down. If we see them continue to do that, that can rattle markets. And at the same time send other Asian currencies, including the Aussie dollar, lower. However, if they start to backtrack, maybe they just, is a kind of one-off couple of days above 7, where they don't move it much beyond there, stocks could rebound and the USD could weaken against those Asian FX pairs. Last but not least, just wanted to mention the big cannabis stocks reporting earnings next week. Canopy Growth and Tilray, two of the most famous names in this particular space, which has seen a lot of speculation. So it's the Q2 results of those two companies. I won't dig too much into the details here, but in essence, both of the companies still making losses and projected to do so into 2020. But those losses are being reduced, and at the same time, they're investing and preparing for what everyone imagines to be the ultimate end goal here, which is US legalization of cannabis. The shares have been falling of late. There was a little bit of maybe excess speculation, you might say. The shares have been coming back off. If you do believe in this longer-term story of legalization in the US and these two companies, for one, being well set up for that, particularly with some of their partnerships with other big US corporations, then these earnings could be a catalyst. Either the earnings are better than expected and we see a bit of a bounce ending this recent decline, or maybe there's further dip and that gives you better value to buy into this longer term growth story if you believe it. Right, thank you very much for watching this week ahead video. If you do like all these videos from LCG and want to see them as soon as they're released, please follow LCG and myself on YouTube and social media.